Hello, students. Today we're going to talk about cross-asset hedging and basis risk spreads. We're going to go into a case study that happened back in 2017, and I think it's really prevalent what went wrong and why it went wrong. So let's kind of just jump right into this particular case study. So what we have is a situation where Australian wheat exporters, CBH, hit by big losses in future contracts. Let's talk about what happened here. So what we saw is Australia's, their largest exporter, which is CBH, have been hit by big losses on future contracts, demonstration on how increased erratic weather patterns make it more difficult to hedge commodity price risk. CBH Group, the country's biggest grain cooperative, reported this week that the use of Chicago Board of Trade wheat futures to hedge its commodity trading has contributed to a net loss of $82 million US in its marketing and trading division in the year September and in a year ending September 30th. Jim Wilson, the CBH chief executive, said the marketing and trading division experienced a set of global and political circumstances during the year that significantly impacted its bottom line. Australia is a key wheat importer for the Asian markets, producing high-quality wheat. Australia is a key wheat exporter for the Asian market, producing high-quality wheat for the production such as noodles. Although the U.S. is no longer the world's largest wheat provider and exporter, its futures market in Chicago, where the bulk of its grain and oilseed markets are traded, have retained their position as a global benchmark due to the level of liquidity they offer. Today, wheat production is concentrated in the Black Sea, Russia, Ukraine, Kazakhstan, as well as France, Australia, and Argentina. So the U.S. is no longer really the breadbasket of the world. Commodity Exchange Group have sought to create price benchmarks for the local exchanges in key producing countries, but these have struggled to challenge the dominance of the Chicago market. I'm going to get into that. There's a risk in hedging with a derivative that's not based on the underlying product, and that's called a cross-asset hedge. And we're going to get into cross-asset hedging as we move through this 8-week course. There's a risk in hedging with derivatives not based on the underlying. As I said, in 2017, U.S. agriculture trader Archer Daniels lost $20 million on its hedge position in the Black Sea, blaming a lack of correlation between the hedges in North America and the underlying movement in the price of grain in the Black Sea. Australia has its own domestic wheat future contract managed by the CME trading group based on a price from commodity price group S&P Global Platts, launched in July of 2017. However, analysts and traders said the liquidity was too low to offset their risk. So we're going to get into what that means, because what happened was that Chicago, realizing the difficulty, created a local future that trades off the Australian Platte wheat. CBA said depressed demand for Australian wheat led to lower prices, although the drought in Australia initially pushed prices higher. So you had a bit of volatility in Australia, and then they were hedging, trying to use what they call a basis spread between Australia and wheat. I'm going to kind of get into that right now. And you can see that Australia is a massive producer and a massive exporter to really the Asian countries. And if you think about that, Asia has massive populations. I mean, think about the population in China, the population in Japan. Southeast Asia has billions of people, and Australia is where these Asian countries get their wheat. And of course, these are countries that use a lot of grain, a lot of noodles, and so on and so forth. So let's kind of get into what we're going to talk about in this lesson. We're going to talk about basis trading and spread trading. It's a little bit complicated, so I'm going to try to go slow. I'm going to try to explain how it works, and hopefully by the end of this lecture, you'll have an idea of how spread trading works. Trading the basis spread between Australian Platte futures and Chicago wheat futures involves a strategy known as basis trading or spread trading in the commodities market. Now, let's kind of go understanding the commodity. Australian Plat futures. These futures are typically based on wheat prices in the Australian market. The pricing and market dynamics are influenced by factors specific to the Australian wheat market, such as local supply and demand, weather conditions in Australia, and the Australian dollar exchange rate. And that's really important, especially if I'm an importer. I'm buying Australian wheat. Now I'm selling it to another country, and it might be a different exchange rate. That's a different currency. Chicago wheat futures. These are futures contracts traded on the Chicago Board of Trade, the CBOT, are based on the U.S. wheat prices. They're influenced by factors affecting the U.S. wheat market, including agricultural policies, weather conditions, wheat growing, how the weather was, so on and so forth, and the strength of the U.S. dollar. Now let's talk about the concept of basis trading or basis spreading. The concept refers to the price difference between these two futures contracts. Traders engage in basis spread trading by simultaneously buying one contract, say the Australian Plat future, and you would do that if you were definitely a importer. If you were buying Australian wheat, you'd want to be long. You'd want to be long the Australian Plat future because you're short the commodity, right? You're buying it, so you want to be long that future, and selling the other Chicago wheat future, vice versa. So I'm going to hedge it. I'm going to hedge my long Australian future against being short the Chicago future. The goal is to profit from changes in the price difference between these two future contracts. Traders anticipating that the spread will narrow or widen based on their market analysis and predictions. Well, remember, this class is about hedging, but also speculators could spread trade just like hedgers could. Changes in trade policies, tariffs, or international relations can affect the wheat markets different in Australia and the U.S., so they're going to be affected by that. We said weather conditions, weather patterns in Australia and the U.S. can impact wheat productions. Currency fluctuations, since these contracts are priced in different currencies, Australian dollar for Australian Plat and U.S. dollars for Chicago wheat. Changes in the USD, AUD, and USD exchange can affect the spread. Localized supply and demand changes in Australia and the U.S. can cause the spread to fluctuate, narrow, or widen. Hedging. Traders use this strategy to hedge against price volatility in the wheat market, but take opposite positions in two different wheat futures. They can mitigate the risk associated with price movement in a single market. So they're hedging their hedge position. Okay, so that's called a cross-asset hedge. Traders need to closely monitor both markets and be aware of the factors that could influence the price of wheat in Australia and the U.S. They must decide the right time to enter and exit these positions to maximize potential gains or minimize losses. In summary, trading the basis spread between the Australian Plat future and the Chicago wheat future is a sophisticated strategy that requires an understanding of the factors that influence wheat prices in both markets. It's used for both hedging and speculating, depending on traders' objective. Of course, our concern here is hedging. What I want to do now is go through an example of basis spreads. And the CME has done a very nice job of explaining this, but not using Australian wheat. They're going to use soybean market between Brazil and the U.S. And then we're going to bring it back around to how it relates to the Australian wheat market as opposed to the U.S. wheat market. But I thought the CME did a very nice job of explaining basis trading, spread trading, but their example was soybeans, not wheat. So let's kind of get into the soybean example, and then we'll spin back around to the wheat example.
The global soybean market continues to change and evolve. Factors such as long-term production patterns, shifting global trade flows, and geopolitical issues continue to impact soybean prices, production levels in various countries, and trade patterns. In the last few years, Brazil has become one of the world's largest exporter of soybeans, surpassing the United States for that title. Both markets have their own production and export dynamics, leaving market participants looking for ways to manage exposure to both regions. Legacy U.S. Chicago Board of Trade soybean futures have been used to hedge global soybean positions for over 80 years, as South America, particularly Brazil, has become a dominant soybean player. Regional pricing alternatives become increasingly important. CME Group's South American soybean futures contract provides market participants a tool to directly manage exposure to the Brazilian soybean market. Settling in US dollars to the Platts index, the financially settled contract will reflect Brazilian export prices at the port of Santos, which will track the Brazilian soybean export price and simultaneously the basis to U.S. soybeans. This offers market participants the ability to trade the spread between these key commodity regions. CME Group's South American soybean futures can be traded on CME Globex or through block trades on Clearport, Sunday through Friday, almost 24 hours per day. Margin offsets will be available for trading between CME Group's U.S. and South American soybean futures contracts. So whether you're looking to offset basis risk or are interested in accessing Brazilian soybean market pricing, CME Group now offers a soybean futures contract to fit your needs.
Okay, so what we saw was understanding how a similar situation has happened in Brazil and the U.S. as opposed to Australia and the U.S. with regards to soybeans. Company using basis spreads to hedge risk for various reasons, particularly in the context of commodities like soybeans. Here's a breakdown of why an importer might buy South American soybeans and sell North American soybean as a hedge strategy. So let's kind of dive into it. Diversification of supply source. By buying the Brazil and selling the Chicago, an importer can diversify its supply source. This reduces the risk associated with relying on a single region for supply, which can be affected by regional issues like weather, political instability, or supply chains disruption. Price differentials. Different regions can have different prices for the same commodity due to factors like transportation cost, quality differences, and local supply and demand dynamics. By engaging in a basis spread, a company can take advantage of these price differences. Hedging against price fluctuation. The price of soybeans can be volatile due to various factors like changing global demand, currency, trading policies. By buying and selling soybeans from different regions, a company can hedge against these price fluctuations. If the price of the one source increases, the loss can be offset by the gain from the other sources. So we're looking to normalize this volatility, especially when you're talking about a very liquid market, which is in Chicago, and a very illiquid market, in this case, which is Brazil. I could trade one against the other to normalize the price and to try to make my hedge more definable. Currency management, we talked about that. Transactions in different regions might involve different currencies. By gauging and trading in different markets, a company can also manage or hedge their currency risk. And of course, different regions might produce soybeans with different qualities or specifications. By trading in different markets, because different markets are going to have different qualities, I can hedge off that quality disparity, especially if my importer is going to be using some and selling some of those soybeans, let's say, to the U.S. market, because the U.S. market is one of the biggest consumers. Some of the cereal companies of, in this case, soybeans, or as well as Asia. Marketing assets and strategic planning. Engaging in multiple markets can provide better market access and strategic positioning for a company. It allows the company to be more responsive to changes in market demands and to have a broader market presence. Leveraging arbitrage opportunities. Sometimes the price differential between two markets can create an arbitrage. A company can buy the commodity in a cheaper market and sell it in a more expensive one, thus making a profit from the price differential. That's not the emphasis on this particular class. Of course, there is a class in the next 8 weeks that is trading, and of course, he can go into that arbitrage opportunity. So what I want to do now is go into a little bit deeper into this basis trading, which I think hopefully will bring it home, and I think the CME does a great job. So let's watch.
Around the globe, market participants trade basis to the U.S. Chicago Board of Trade soybean futures contract. Basis is the price premium or discount for the physical commodity in a specific location relative to the futures price. It is driven by local supply and demand, as well as transportation costs between markets. For the North American region, the basis is referred to as weak when cash prices are low relative to the U.S.-based CBOT futures price. This typically occurs when supply of a physical commodity is great relative to demand at the cash market location. Conversely, the basis is considered strong when cash prices are high relative to the CBOT futures price. This occurs when supply of a physical commodity is tight relative to demand. This basis relationship is also applicable outside the United States, as basis risk exists around the world for those involved in international trade for commodities such as soybeans. Brazil is a leading global producer of soybeans, with a major export port at Santos. Because exports are a major factor in overall demand, importers and exporters have significant exposure to basis risk in this region. Historically, this basis risk could only be managed through buying or selling the physical commodity. With the launch of the South American soybean futures contract, market participants have an additional way to manage basis risk. Utilizing the South American soybean futures contract, market participants will be able to synthetically trade the basis. This is done by spreading the U.S.-based soybean contract and the price represented by the new South American contract. The spread, or basis, between the two is defined as the South American contract less the U.S. contract, converted to cents per bushel. This relationship between the price of the two contracts should reflect where the actual basis stands at any given point in time. For example, if traders sell the South American soybean contract and buy the U.S. soybean contract, they are synthetically short the Brazilian soybean basis. Conversely, if traders buy the South American soybean contract and sell the U.S. contract, they are synthetically long the Brazilian basis. As an example, let's assume the South American contract is trading at $374 per metric ton, and the U.S. contract is trading at $9.82 per bushel. Converting the Brazilian price from metric tons to bushels gives us a value of $10.18. Subtracting the U.S. soybean futures price of $9.82 gives us a basis of 36 cents over. If an importer of Brazilian soybeans is concerned that the basis was going to increase or strengthen, they could buy South American soybean futures and sell U.S. soybean futures, creating a synthetically long basis position. If the spread strengthens, their physical position would lose value, but would be offset with a gain in the spread. If the spread narrows or weakens, their physical position would improve in value, but that gain would be offset with a loss in the spread. Conversely, if a Brazilian exporter is concerned that the basis is going to decrease or weaken, they could sell South American soybean futures and buy U.S. soybean futures, creating a synthetically short basis position. If the spread weakens, their physical position would lose value, but would be offset with a gain in the spread. If the spread widened or strengthened, their physical position would gain in value, but that gain would be offset with a loss in the spread. Well, the Brazil versus U.S. basis spread won't allow a trader to take or make delivery of Brazilian soybeans. It does allow them to trade the basis without the credit counterparty risk present in the cash market. Market participants also benefit from the fact that both contracts trade on the CBOT, making the spread easily executable. Additionally, it also reduces transaction costs compared to trading a paper or physical basis market. So whether you're looking to manage regional basis risk or speculate on basis direction, CME Group allows you to do so, all in one marketplace.
Yes. Here we have two charts, and what we want to look at is the period when we essentially took a hit on the trade. But we can see here, this is where the company lost $81 million. And you can see that the illiquidity in the Australian wheat futures market, as opposed to the imported, the CBOE market, you had a massive breakdown between those two assets, where we had really a drastic weakening of the basis. And let's kind of go through the example so we kind of understand it. So we have the local spot. We're going to treat the Australian future as the spot because we're talking about an importer now. CBH is an importer. So they want to be long the Australian market because they're short that and they want to hedge by being long. But they're going to hedge that hedge because of trying to normalize the price by treating their futures position in Australia as the spot, and they're treating the futures contract in Chicago as the future. And so we understand that they're long basis, okay? They're just like the video, they're long the basis. And what we want to look at is the fact that the spot when the trade started was 265 and it had dropped to 230. Okay. And so think about this, students, if I am an importer and the spot goes down, that's good for me. That's very good for me because that means I'm paying cheaper. But the problem is that I'm sitting on a Australian long future and I'm hedging it against a CBO future. And what happened was that those prices actually didn't go down. They went up from 160 to 190, which is expected, but you had a massive move from backwardation to contango. And when you move from backwardation to contango, it showed a 65-cent loss on that position, on that spread position. And if we look at from this point, we can see that we had a 35% drop in the spot, which is a benefit, but we had a weakening of the basis. And that weakening of the basis essentially was a 65-cent loss. So when you add those two together, you're realizing that you're going to come up with an $81 million loss. Because you could say you were overhedged on that position because you went from essentially a backwardation. You were 265 and the market dropped to 230, but the Chicago market went up to 190 from 160 to 190. And that massive change, that 65% loss, opposed to that 30-cent gain, is, you could say, was overhedged, and that's why they lost. So the erratic move, and really what we're talking about here is the illiquidity that was really taken into account. In fact, I have a nice summary here. In light of the market moving from backwardation into contango due to the liquidity of the basis weakening more than expected, the local futures dropped 35 cents, benefiting the importer. However, the basis spread increased by 65 cents, resulting in an $82 million loss. Now remember, students, it's really important that you understand the difference between a weakening and a strengthening of the basis. When you go from steep contango moving into backwardation, you're getting a strengthening of the basis. So in this case, we had a dramatic weakening of the basis, which caused an $82 million loss. Hopefully this was helpful. We'll see you next time.